Hello, this is Geoff Bysshe, President of MarketGauge.com, filling in for Keith with the Market Outlook this week. Please be sure to fill out the Trader's Survey. It's one simple question that you'll see down at the bottom of this video for a limited time. All you have to do is click the radio button, place your vote, and we'll send you the results later in the week. The results have actually been pretty insightful in terms of when markets have turned. So take a minute, do that, and we'd really appreciate it. So this week, the theme of my presentation for Outlook is really that if the market continues to go up, there's not a whole lot to talk about. We're going to continue to trade the strong stocks and the strong groups that are moving up. But there are a fair number of points to watch out for that could indicate that if we see another pullback like the one we just saw, it may not be a good pullback to buy. In fact, it might be an opportunity to get onto the short side. So I want to give you a couple of heads ups to be looking for in the event that the market does move lower. Let's start with the internals, and we're looking right now at the McClellan. Keith covers these internals every week. I'm not going to do anything that you haven't seen before on the internals, but I do have a relationship that Keith hasn't covered that I think you're going to want to stick around to see a little bit later in the video. The McClellan, we like to be above the 150 or below the minus 150 to get really interested in a reading. We got pretty close down at the bottom of this short pullback. Wasn't very oversold. I don't, for that reason, can't expect it to be telling us that we could have much of a bounce or that we got a whole lot of a flush. By the way, this little low in here, an oversold level down in here, this lined up with the trader sentiment level. So now we've bounced and we're back up, touching the highs. I'm going to cover the specifics of the price action coming up, but I don't think McClellan is really giving us a whole lot of insight in here that we have to overanalyze or worry about. In terms of the VIX, is kind of like the McClellan, really hasn't gone anywhere of significance till we get below this lower band. We can't say that the market's too complacent until we get up above the band, or if we break the 200-day moving average here. Do we really want to say there's much of a warning? I don't want to overanalyze anything that isn't jumping out as having some significance to it. If we take a look at the 10-day advance decline, Keith talked about this last week. He had the volume as well. I don't have the volume up here. They were both down near the lows and both turning up. He said it would be an interesting double confirmation if they both turned up. In fact, they did, and we saw the rally, the type of rally that you might expect to get going given the levels that was sitting at. Now, again, just like the McClellan, once we move back up into the middle here, I don't think there's much we can really count on this indicator for until it gets back down or back above to a significant level. Now, in terms of it, Keith doesn't always go over these, but here are some shorter term oscillators, and I'm bringing these up because here's the 12-day on advanced decline. It's going to be somewhat similar to the 10-day, although the 10-day is calculated as a running sum. This is calculated as the last 12 days. You can see it got down to a point that would typically indicate could be in for a bounce on both of them. We like to see them both happen at the same time. We got that. We got the bounce. The reason I'm emphasizing it today is that the markets are not oversold. They're not overbought. All right. When I go into the price action, I'm going to show you the price action, some price action patterns that to me are very concerning for the bulls. But I'm covering the internals first because I want you to see that as far as the internals are concerned, this move up has not been any kind of move of exhaustion. We're not overbought. We're not overbought even on the shorter term indications that we have. Okay, so we are not overbought. But we have followed very nicely along the path of a market that got a little ahead of itself on a major breakout. It pulled back to an area that made a lot of sense for it to pull back to. It did get modestly, very modestly oversold in terms of the internals. In terms of our short-term sentiment, the trader sentiment, it actually got really oversold. And so those things together, I would say, push us back up here. All right, but let's take a look now at the price action. And today, Friday, was potentially a very important day. We got jobs numbers, unemployment numbers that were surprisingly good. So surprisingly that there's talk in the media about how this could possibly be rigged. I'm not even going to go there. The point, as far as trading is concerned, is let's assume it's not rigged, but it was good news. Okay, unemployment dropped to, I believe, the lowest level since Obama's been in office. I mean, granted, not that great, 7.8%. That's probably going to be all the headlines over the weekend. Nonetheless, the market got off to a good start, the gap higher as you might expect. But as we look at the Qs never really got going. Now, I know the Qs are heavily weighted by Apple, and Apple, if we have time, I'll look at Apple, is looking quite heavy. And so that was a big drag on the Qs. But IWMs, we can't, the Russell 2000, we can't peg their poor action on Apple. So I'm going to cover both of these. I'm going to start with the Qs, and this is the action that I was suggesting earlier is quite negative, and I want to bring to your attention. We have a pattern here commonly known as the engulfing pattern. Okay, that's part of the negative that has me concerned. The other thing is it happened at an area of a prior high. It happened in a really logical point for the market to sell off from. This area of congestion up near the highs kept it down. But the most concerning point of this chart is that the green line that you see here, which I'm now overlaying in blue, is a 10-day moving average. The red line, which I'm now overlaying in blue, is a 20-day moving average. The pattern that I don't like is one, that they're crossed, then two, that we tried to get back after breaking down through the 20 convincingly, tried to get back above the 20, and we couldn't. Now we're back down below it, and the moving averages are crossed negatively. What that means is that the attempt to reignite the bullish momentum on the 10 and 20-day periods is potentially failing. Now, when will I know that it will? When will I know that it's failing? When will I be more convinced that it's failing? When we break some resistance levels created by trend lines moving up. This particular low, the Monday closing now below this Friday low, will be further confirmation that the momentum is rolling over. This is what I mean when I say buying this next pullback is not the same as buying the first pullback into the 20-day moving average. All right, so if we look for that same pattern, and the pattern again is break the moving average. By the time you rally back up above the moving average is now flattened or turned negative, and a faster moving average, in this case the 10, has come below it, and is literally it's acting as gravity on the market pulling it down. Now, if we continue to move higher and we never get the confirmation of the rollover, then it will pull everything back up, trend resumes, trend continues. So the importance of the market not being overbought, which is what I started with, is that the market could continue to move higher, could break out of these highs and continue to go. If that's the case, play it from the long side. But if we start to break down here, big warning sign is what I'm doing for you right now. Now, let's take a look at the IWMs. All right, same pattern. It broke out today, ran, actually was one of the stronger intraday performers. The other three, the SPY, the Q, and the diamonds, all rolled over before the IWM really rolled over today. IWM's right back into some significant support, so it could very well hold and continue to chug higher, but if it continues to move lower, I think we're looking at a significant move to the downside. And the other thing that concerns me with IWM is the location. Okay, let's go to the weekly chart. The weekly chart of IWM, and you can see that where the Qs and the SPYs and even the diamonds have broken out of major yearly levels, IWM's just matched it. So the broader index didn't break out in the same way. This trend line from the 2011 highs, or I should say resistance line from the 2011 highs, makes perfect sense as a breakout, perfect sense for it to retrace back to, but what we don't want to see is it to continue to move lower. All right, if you notice on a weekly basis, inside bar, we've broken down, everything's moving in the direction of and has played out a topping formation. So again, if we move lower, it's playing that tune rather nicely. If we take a look at the SPYs, and let's take a look at the SPYs on a daily basis. Actually, before we go to the daily, I'll show you what I mean. Okay, so you can see that on the SPYs have broken out of their 2011, 2010 highs. They're at multi-year highs, pulling back where they pulled back to. Perfectly natural. No warning, no real reason to be overly concerned there, and that's why buying that dip made some sense. But on a daily basis, you know, on a daily basis, we can see they stopped at a relatively reasonable point. I mean, this is where the market had trouble, consolidated before. Not to be surprised that there's some good resistance, but they haven't come back under their moving average. Their 20-day moving average still solidly stacked higher. This is the reason why markets could continue to move higher. All right, the SPYs have held up relatively well here. It was a disappointing day in the way that it sold off all the way down into the prior day, but for all intents and purposes, on a closing basis, SPYs still look pretty good. The Dow, the same thing. Looks pretty good in terms of how it's held up. On a closing basis, it's probably the highest close. We may see that in the headlines, Dow, the highest close. But one of those patterns, you always look back and say, how did I not see this when it happened? We took out the highs by just a few points. And so again, if we start to move lower, I wouldn't normally be as concerned if it wasn't for the way the Qs look. But if the Dows start to look lower, people are going to start looking at this as a really nice looking double top. If we break out, you got to follow it. Okay, another thing you might want to do, I'm going to do it for you, is take a look at some of the sectors that have been moving higher. XLV has, I would say quietly, I haven't seen a lot of coverage of it, but XLV has really had an incredible breakout here. Healthcare, an incredible breakout over the last couple months, and it has just continued. The only reason housing has gotten more attention, I think, is because it's coming from such a low level, and it's a bigger component of the overall economy. But at the same time, everybody's been saying how well housing's been doing. Healthcare has had quite an amazing run as well. So looking at that, keep this in perspective. Here's the sell-off, right? And this broke out last couple days and has really run nicely. The moving averages here didn't even come close to being affected. So here's, if the market does sell off, this is one place you're going to want to look if you want to stay bullish. Look for some long opportunities. You'll also want to keep an eye on this because it's one of the strongest sectors. If it starts rolling over, that wouldn't be a good thing. But I suspect that by the time that's giving you an indication, the market will probably have already given you other reasons to be negative. Now, here's housing, right, or the home builders, XHB, and just like the Dow, 1, 2, and now 3 tops here. So again, if this starts to break down, come back down here, we're going to want to really consider the fact that it had some real difficulty up there. Doesn't have to mean the whole move is over. It just means it's gotten a bit ahead, potentially gotten a bit ahead of itself. And what was leading, and this is the important thing, what was leading could now be starting to falter. All right, let's take a look at the TLTs. I know Keith covers this probably every week, and don't remember exactly what he was saying about it last week, but I have a couple key points here. One of the indicators we look at in our market analytics, our overall analytics over on our Little Big View product, which is free, is the percent change in the long bond rate. So let's call, and here's the 20-year close enough. That basically, if you get a 10% move in the rate over a 6-month period, it becomes really negative. Well, without getting too into the math, a couple of things could potentially happen. When I say gets negative for stocks. So while the Fed is trying to keep interest rates low, here's the day in which Bernanke made his announcement of indefinite quantitative easing. Yeah, that should be the Fed saying we are going to do everything we can do to keep interest rates low. But where are we? We're right back where we were on that particular day, and it looks like we're heading lower. So what happens if we actually get down here? Why might we get down there? Well, we were there in April. We were there in October of 2011. If we get there, it's going to be a pretty significant move over the last 6 months. Typically, that's not good for stocks. Now, I wouldn't be saying we're going to get down here if it were not for the fact that what's happened. Remember that pattern I talked about in the Qs? Well, here's the same pattern as it played out in the TLTs with respect to the 50-day moving average. Okay, we broke down, we rallied back up, tried to get above it, we couldn't. Once we broke down from it, that was a significant sell-off to follow. And the next bounce up doesn't make it over the 50. Now we're back down again. Now we're looking at the 200 has been support. We're at an area of support, and we're at a really big trend line. All right, a trend going back essentially You could say back to the early 2011. So doesn't seem very unrealistic after its last attempt to get above this high right here. It's potentially failing as of Friday's close. If the momentum continues to move lower, not good for stocks. All right, so watching out for the TLTs to move lower could be a negative, real negative drag on stocks. All right, now I told you I was going to give you one other ratio which we don't usually talk about. And that ratio has to do with consumer discretionary. This is another sector I would watch really closely for decline, because a decline here is probably going to mean a bigger heads up of negative things to come with respect to the overall market. And again, you can see it's stopped at a logical place, so I don't think this is a really crazy call to say be logical for it to start to head lower again. If it breaks out, again, I'm not going to argue with it, but if it pulls back, I'm going to give it extra attention. And here's why. All right, I want you to just take a look at this relationship. It's rough, but if you see the black line moving up, you will see the SPYs on the top, right? So the relationship on the bottom, the SPYs on the top. Well, the black line's moving up, the SPYs have trouble. Okay, shorter term, the line moves down, the SPYs move up. The line accelerates up, the SPYs accelerate down. We get a really crazy volatile period. You got a crazy volatile period. As these move down, you get the picture. Okay, look at the bigger picture here. We're moving down in this period. We're moving up in the SPYs. In this period, we start to move up. Stocks move down. Stocks start to recover. We move down. You can see how this story ends. We're moving up. Here's the heads up. Okay, are we starting to move up? Are we starting a volatile period? I don't know which it is exactly, but it's a significant move higher. Stocks have reacted to that move higher. And so what? Same thing I've been saying. If this continues to trend up and stocks move lower, it's an indication that a move lower in stocks is something that could be a move you really want to, we might be looking at the 50-day, maybe even a 200-day pullback in the overall market. So what's the relationship? If you haven't already looked at it, it's the XLP, the staples sector, versus the XLY, the discretionary sector. And that's why I just said watch out for that discretionary XLF back here. Here's your XLY, and here is XLP. So XLP has moved higher. All right, consumer staples broke out to the new high. XLY didn't break out to the new high and is moving or potentially moving lower. So if XLY accelerates down faster than XLP, that ratio is going to go up, and that's the relationship that typically is telling you that the market's weak. Now we're going into earnings season. That could throw fuel on a fire to the downside. It could negate the negative patterns that I'm talking about here. Always want to look ahead. You always want to let the price action tell you what to do next. I hope that the analysis has helped. Hope you'll take the time to vote in your trader sentiment video, and I thank you for being a member of the Market Gauge list. Have a great weekend and a good trading week.